Hi, I'm Elrod Khleif. Each and every week, I record an interview with a thought leader that I know you're going to get a ton of value from. Now, here on YouTube are the video versions of my podcast, Lifetime Cash Flow Through Real Estate Investing. Now, to make sure you get the latest information, please subscribe and hit the notification bell. Let's get started. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. And I know you're going to get great value from the gentleman we're interviewing today, but I want to caveat this. This is going to be one of those episodes where it's not strictly multifamily driven. And I'm going to do these from time to time, and maybe I've already done one by the time this one comes out, where if I feel you're going to get value from it, we're going to talk about it. And so it'll be kind of an anomaly episode, this series where, we do different asset classes, different opportunities that I think are going to add value to you. So my guest today is Hunter Thompson, and Hunter actively raises investment capital for multiple asset classes, including multifamily. But today we're going to focus on self-storage. Hunter, welcome to the show, buddy.
Hey, thanks again for having me on. I really appreciate it.
Absolutely, my pleasure. So let's talk about your background initially, how you got into this real estate game, and why you love self-storage, and maybe even some of the other asset classes that you're familiar with.
Sure. So I studied economics as an undergrad and was really interested in economics as a whole. Now, not that I really learned any real life things in undergrad with economics, but I was just really interested in the topic. So when the real estate collapse happened, I was instantly drawn to all financial assets. I knew there was going to be some kind of opportunity there. I didn't know exactly where. My first inclination was towards stocks, just because that's where most of the marketing is. That's where most people are more familiar with. So I study the stock market, not on a day trading basis, but basically looking for long-term holds. And that was successful, obviously, in those early years because the prices had been so deflated. But I really started to be skeptical of stocks as I started to realize the lack of predictability and the lack of being able to plan for your future. Because most people's goal, when they really get down to it, is being able to have their passive cash flow pay off all their expenses. But stocks is not a great vehicle in which to accomplish that goal. It's a very indirect way to accomplish that goal. You have to have extremely high net worth to do so. So I was kind of teetering with that idea, and then the European debt crisis happened. For most people, 2008 was a big wake-up moment for them. For me, it was the European debt crisis. And the reason for this is that mostly the same thing happened in the United States, but it happened in Europe, where a lot of banks froze up. There was a lot of challenges with liquidity.
What year
and I
was
remember that? About 2009, 2010.
Okay,
2010
so
when it was getting
ours. Okay, all right.
Exactly. Kind of the global financial crisis. It melded into Europe, where they had some really problems with solvency and liquidity. And so it was causing great variance in the market and volatility. And I remember watching CNBC, just being obsessed with this, trying to wake up at market timing in Europe, et cetera. And they were talking about the Greece bond yields. And they were saying if the Greece bond yields went above 7%, that the S&P 500 was going to collapse. If it stayed below 7%, the S&P 500 was going to be fine. I remember thinking, it was 6 a.m, watching this, how is it the case that the Greece bond yields are playing a role in my financial well-being, let alone a significant role where people are even talking about it? And that was really my last straw moment with the stock market. And when that happened, I thought, okay, there has to be a way to invest where you can provide predictable cash flow, where you can actually conduct due diligence. The simplicity of the investment must be so that a small office or an individual person can actually mitigate those risks, as opposed to something like the Greece bond yields, which not even a huge group of people, the billionaires of the world, they can't predict that or mitigate that risk. So later that led me down the path of real estate and, ended up where I am today.
Wow. Wow, that's quite a path into real estate, and I completely agree with you, by the way. But I just meant about the whole utilizing Greece as an example. I mean, I remember was it Iceland that went bankrupt back then, and there was all kinds of economic turmoil happening. So what was your first, let's go back to, you decided to get into real estate. So this was after the '08 crash. What was your first asset class that you got interested in and invested in, or brought investors into?
So when I first got started, I was really drawn to single family. I think for a lot of reasons most people are. They
Sure.
see the low entry point price. Most people have lived in a single family at home at some point. They're relatively familiar with it. So I didn't want to be hands-on in terms of actually rehabbing and flipping. My goal was to look at things on a risk-adjusted basis and at least have one person or company in between me and the asset. So the first investments I made were essentially hard money loans for people that were experts at flipping properties. So obviously, a lot of your listeners are familiar. If you buy a property, you buy a home, if your own home, and you get a loan from Bank of America. If the toilet breaks, you don't call Bank of America, right? You fix the toilet or you call a property management company. And
Right.
that was kind of my thinking going in. So at the time, there was properties in Memphis, Tennessee, St. Louis in the $100,000 range. We would loan up to $60,000 on those properties based on after repair value. So 60% loan to value, we were able to achieve, let's say 13 or so percent, 12%, somewhere in that range. And I was basically thinking, 60% loan to value, these have a very low risk profile and you're still able to achieve double-digit returns somewhere in that range. Now, of course, a lot of those opportunities have dried up. Those returns aren't exactly achievable anymore as the margins have kind of collapsed as the market's recovered. But at the time, some of the best investments I ever made on a risk-adjusted basis because you have really strong collateral there. But kind of to segue into some of the other assets, the challenge with single family, in my opinion, is that the simplicity of the investment, while it does make it straightforward in terms of conducting due diligence, it also doesn't allow a significant difference between a best-in-class operator and a mom-and-pop operator. So the difference between, let's say, having 2 or 3 single-family houses and having 100 doesn't allow you that scalability, that true economies of scale that commercial real estate and multifamily and self-storage can provide. And so I was then drawn later down the road to, et cetera, the multifamily sector and the commercial real estates as a whole.
That's funny. I got that memo as well after 2,000 houses in a buy and hold, including 200 in Memphis. And got that memo in 2008 when the market crashed. If I'd have just been in multifamily, I would have been just fine. My multifamily did just fine. So yeah, you were smart enough to get that memo before you before you went down the path as far as I did. That's actually the reason I started the podcast, was to convince people to do multifamily instead of single family. So let's talk about self-storage. Let's get into why you're on the show today. So talk about why you love self-storage as an asset class.
Yeah, sure. So I'd say, I just want to touch on something regarding single family to multifamily. This is something I've repeated a lot, but I think your listeners will probably think it's interesting. You'll find it really telling that you almost never hear someone say, well, I got started in multifamily, but it just wasn't for me. And now I'm going to try to buy 300 houses. And that should clue you in, right? But
That's
you
a
understand
clue.
why they make the mistake. Exactly.
No, that's exactly right. The progression is never that direction. It's always the other
Exactly.
direction, and in my case, I was just, I just loved single family. It was easy for me. And frankly, I got lazy. I had apartment complexes as well, but the houses were just so easy for me. And I don't know why. It really is. They actually are much, much harder. But in my view of the world, my model of the world, they were easier. But anyway, self-storage. Why do you love self-storage?
Sure. So when I'm looking at investment goals, all the cash flow is there, gaining value through appreciation, et cetera. To be completely honest, that why factor really comes down to being able to sleep at night. And that was why that Greece situation was so profound, because it was the opposite of what I was actually trying to accomplish financially. So when I looked at all of the investment vehicles that are out there, what I was trying to find most importantly was non-correlated assets that perform well in all stages of the cycle. And 2 really kind of came to mind. One being mobile home parks. I think a lot of us can understand that the worse the economy does, the more demand there is for affordable housing. With self-storage, it's not as clear on its face, but it's just as compelling in my opinion, which is that people are more likely to go through some kind of transitional period during recessions. And those transitional periods very frequently result in people having demand for the product of self-storage. So you think about people downsizing, kids moving home from college unexpectedly, layoffs, job changes, et cetera. All of those things are more common during recessions Then on the other side, when things are really good, when things are expansion, we're experiencing an expansionary period in the economy, people are more likely to buy toys. They're more likely to buy jet skis or RVs, and those things need to be stored as well. So self-storage catches both sides of the spectrum. I'm not as worried about the good side. All assets do well when the economy is booming and the capital markets in particular are loose. But if I can protect myself to the downside, even if it's just a piece of my portfolio, it's going to help me achieve my main goal, which is just being able to sleep at night.
Yeah, it's asset preservation. So let me ask you this. Historically, and I don't know the answer to this question, historically, how did self-storage do through the 2008 debacle?
Yeah, so there's a lot of data out there on this topic. I have an ebook on it, which we can link to in the show notes page. Okay. But basically, both in 2001 and in 2008, rents were relatively stable. Now, part of the data there that's important to consider is that the asset class is relatively new in the sense that, 1985 or so, the first self-storage buildings were really being developed in the United States. Okay. And so when you look at 1995 to 2010 or so, the asset class generally basically doubled in size. Went from about 25,000 facilities to about 55,000 facilities. So the key there is that during that doubling with those two recessions, you still saw real stability in rents while the square footage per person was essentially doubling.
So what happened? We talked about that the rents remained stable, but what happened with vacancies in 2008 in the self-storage industry? Because I know in multifamily, certainly there were higher vacancies and slow pays and bad debt and all that stuff increased because particularly and maybe more in submarkets than globally, or than in the entire country, based on the types of jobs that people had. But what happened in the self-storage space?
Yeah, so overall, we saw a couple different things happening. We saw rents basically staying stable during the recession years. The occupancies very stable. Now, generally, like I said, the expansionary period was such that the business was basically doubling in size. Right. But during that period, you're seeing occupancies going from about 83% to about 79% over the duration of, let's say, 1995, 2010. And the data that I'm talking about, if you Google Cushman self-storage recession resistant, it is a brief article written by a third party where this is a chart which has just all this data that's really compelling. And the chart's pulled from REITs. So obviously there's a lot of business owners, a lot of self-storage owners, the vast majority are non-REITs, but that's the only way, in my opinion, to get accurate data is for those public companies, they have to disclose that. So that's where that data is from. Okay. All right. Super. That was Cushman. What was that domain again? If you just Google Cushman self-storage recession resistant, it's an article trying to, basically they're trying to say, is this asset class actually self-storage? Essentially, does the thesis line up with the data? And I found it to be very compelling. Okay, awesome. So talk about, so that's sort of very recession resistant. Talk about, why self-storage generates really respectable returns, why, as opposed to other asset classes? So the thing with self-storage is that I think a lot of people, even investors in the asset class and owners, think of the business as a relatively hands-off business in the sense that they say, okay, look, you're building a structure. It's not very complicated. You're not really offering a lot of amenities. So it's a great deal because you can just buy it and you can rent it out. Now, right. And you just hose it out and right. It can be possible. You can be profitable doing that, buying at a reasonable cap rate, et cetera. But there's a combination of two things. Number one, there's incredible fragmentation in the business in the sense that a lot of the private equity groups are not terribly interested in the asset class because the purchase prices usually are not high enough to attract them. But also you have really unsophisticated managers generally, but you also have so many ways to add value to the property so that there's a ton of complexities. So like earlier when I was talking about single family, is the property rented? Is it not? Are you getting defrauded by your property manager? That's really those are the moving parts. With self-storage, you can number one, SEO and internet sales can be a huge part of the business. So you have to be sophisticated to do that.
It is
you
a
can
business,
also,
though. Let's
exactly.
be very clear about that. It's not something you buy and leave. I mean, there are employees involved. There's other things that I mean, certainly multifamily is a business as well. But okay, I'm sorry, I interrupted you. Please continue.
No, that's exactly the whole point. So the complexities of the business allow for there to be a significant difference between a fragmented non-major player and a best-in-class operator. So the things are like building relationships with U-Haul or nearby universities or military bases, actually knowing how to conduct marketing like that. I mean, the relationship with U-Haul is one that is very favorable on a risk-adjusted basis. So essentially, we will buy properties based on in-place income that aren't implementing the strategy. Within 60 days of buying the properties, we call our contact at U-Haul. We have them park their 15 to 50 trucks, depending on the size of the facility, on our facility. Then we rent out the trucks to tenants and get a commission for facilitating the transaction. I have personally invested in properties where that one line item has added $3,500 a month to the bottom line.
Wow.
And that is not uncommon, right? And the critical thing about that is that is not a capital expenditure. You're not incurring that type of risk. You're not expanding the property. You're not developing. You're not relying on the city to give you the correct zoning. You're just leveraging that relationship.
You're just creating additional income, bottom line. And
exactly.
It's straight to the bottom line. So let's drill down a little bit. Let's get a little bit micro. So if someone were to look for self-storage, they're interested in this asset class, get some high level tips for, the sorts of facilities they may want to look for, how they might do a little market research. What sorts of things might someone do?
So everyone's strategy is going to be different. I have kind of a niche strategy for a variety of reasons. Again, when it comes to investing, diversification is one of my main goals. So the first thing I want to make sure is that we have at least 50,000 square feet, in the sense that that'll allow for about 400 units. That's going to allow you to be in a quality property, and there's going to be a significant amount of tenant diversification, but you're also going to get economies of scale in the sense that you have to have a property manager, at least the strategy that we do. We don't do all the automation. Right. But that property manager is going to cost the same if it's half that size or double that size. So you want to take advantage of that.
That's a fixed expense you can't eliminate. Now, let me ask you this. Do you typically flag your properties like a hotel? Like do you subscribe to public storage or some of these other national flags? Is that how this business works? I don't know if it does.
I'm not sure. When you say flag, what is the?
Well, like in the hotel business, you build a hotel and it becomes a Hilton or a Hyatt or a Days Inn, whatever, and you're basically it's effectively a quasi franchise in that you're utilizing their marketing infrastructure, their policies and procedures. You have to you're held to a higher standard. All of those things. Does that exist in the self-storage space?
Yes, good question. So what we do is we partner with the top tier managers in the US and leverage their infrastructure, and not only in terms of their relationships with brokers and their regional managers, et cetera, but also their branding. So when we invest in a self-storage facility, we are leveraging that pre-existing infrastructure, their time, energy, expertise, and access to capital with our investment capital. So that's how we're positioned in the marketplace. And I do think that's critical.
No, I agree. That wasn't my question though. My question is in this space, let's say you were to build a facility, you were able to and obviously you'd probably need the experience to arrange the financing, but do operators build facilities and align with a national brand?
Understood.
Okay.
I see. So typically sponsors will have their own brand.
I see.
And
okay.
They may not necessarily operate under the same name as their management company, but that's typically in the industry standard.
All right. So the answer is no. Okay. It's not like hotels where you'd build and operate in the name of that. Got it. I just
not the strategy we do.
Right. I didn't even know if that was possible. So let me ask you this. So 50,000 square foot's the sweet spot so that you can hire a manager and have the economies of scale and how big of a piece of land do you need for that? I mean, obviously you can go up if you want to. Does that impact the desirability?
Yeah. So I like to have single story because in most of the markets that I'm looking for, just to give you an idea, we're usually looking for, the Southeast is a great market for self-storage. We can get into why. So, 30 minutes outside of some Florida market. I like to be in kind of a quasi tertiary market with a little bit of growth, but that's the way we'll be able to achieve that cash flow.
Okay.
I like to be single story because it allows for drive up, and drive up you can create a premium for. So when you get into the double, it's not a problem. It's something that we definitely look at, but it's more like because of that tertiary market, you're able to do that single story asset.
You can get the land.
Exactly.
Big enough. Okay. And so just give me an idea of how many acres you'd need for 50,000 square feet. Just curious.
I'm not sure. I don't know the exact number of acres. I can't give you that, but it's relatively, like, based on the numbers that I've seen, a significant portion of the acreage is dedicated to the asset. So you don't have a big layover in terms of unused land, for example.
I see. Okay. Well, here in Florida, you'd have to have some water retention and that stuff, but but okay, fair enough. I just to kind of get an idea. What is the zoning requirement for self-storage? Is just a basic commercial designation, or?
So yeah, I mean industrial, and so exactly.
Okay. Is it advisable? I suppose it'd be more advisable to try to find an existing facility and take that down. What sort of cap rates do you see for self-storage, and is it geographic? I mean, I'm certain it's market driven, but what are you seeing?
Yeah, so that's actually a good question. I wanted to address the risk profile, the strategy in terms of developing or value add, and then talk about the market as well and the cap rates.
Great.
The reason is that from my perspective, there's so much mismanagement out there that you can quantifiably decrease your risk by buying properties that are mismanaged that have in-place income. To me, proven demand is very, very different than having a 18-month, let's say, development process after which you say, trust me, we're going to be able to rent this thing up at 5% per month. That's certain people's strategy. That's just not mine, especially when it comes to investor capital, basically because of the mismanagement. If you can just implement those strategies, you're well on your way to not only potentially achieving a lucrative return, but more importantly, protecting your equity. Because that U-Haul strategy, for example, I think some people see that and think, wow, this is going to produce a great return. Well, I think what's much more important is that if there is a capital market correction, it really is just a good way, a low risk way, a relatively low risk way to protect your equity, which is really critical. Now, with that in mind, because the business operates on monthly leases, you can implement those strategies very quickly. So if you have admin fees or late fees, or you want to implement rental raises, you can do it within 30 days, which is also great for some things like inflation, stuff like that. So
what you're saying is when you, I'm sorry, when you purchase a property,
absolutely.
you can do this repositioning almost overnight because it's month to month tenancy effectively. Is if I'm hearing you correctly?
That's correct. And so because of that, and this is just my opinion, but because of that, the in-place cap rates can be somewhat misleading in the sense that the value add can be created quite quickly. So in a market, yeah, exactly. So in a market that, let's say, is trading at a six cap, we may buy at a 4 cap and underwrite that to a 6.5 cap within the next, let's say, 18 months or something like that. That may sound somewhat aggressive, but historically speaking, I think that's a relatively reasonable thing to achieve given the strategies we're kind of talking about.
So how do you identify mismanagement? Tell me the sorts of things you look for.
So, number one, we want to look in markets that we think make sense. We only want to look in markets where there's a supply-demand disequilibrium. So it doesn't matter if the property is really mismanaged and it's the middle of a place we don't want to look at, right? Okay. So once we kind of identify the circumference and we familiarize ourselves with the property, you can see very quickly, is this facility an extremely safe and intriguing and branded property that's operating in the A class of self-storage? And I think people hear A class self-storage, they kind of like, what possibly does that mean? Like, do you guys have a pool or something like that? It's really a combination of the amenities that are offered, the accessibility, 24-hour surveillance, security, things like that. Majority of the tenants are women. So you want to cater to an audience that feels safe. They recognize the branded merchandise. They recognize the colors when they see them. things like that. And I'm not sure what your question is.
Interesting. Let me circle back to something that you brushed over, and that is your area demographical research. What sorts of things do you look at in an area?
So obviously the challenge with self-storage is overbuilding. The reason for this, it's a straightforward structural thing. So you can frequently build the property cheaper than you can buy it. So the real key with the asset class, and when it comes to due diligence, is identifying radiuses where there's a negative supply-demand disequilibrium or a favorable supply-demand.
And how do you do that?
So what we want to find, the national average is about 7.7 square foot of self-storage per person. Okay, and that's on a national basis. So what we want to do, a good first piece of due diligence, is finding a market, let's say with a 5-mile radius or 3-mile radius, where there is less than that. Okay, so if you have a market where there's a certain number of population, and let's say it's only 4 square foot per person, you can actually do the math and say, okay, this radius here is 250,000 square feet undersupplied, in the sense that there could be 2 or 3 reasonably sized facilities developed in the next 18 months, and you would still be able to raise rents aggressively and push rental income. Okay. So again, that's a very large generalization. Certain markets.
No, I get it, but just
but it gives you a good idea.
Looking for. Okay, all right, and then do you? I assume you take a look at the, you look at the competition. Do you gauge their vacancy? Do you do those sorts of things as well, like you would in the multifamily space?
Absolutely. And secret shoppers are a big part of the business, again, because of that complexity, in the sense that you can see that they're advertising a certain rate, but you don't know what is going on behind that rate. Are they mandating that all of their tenants have tenant insurance? Are they charging aggressive late fees? Are they charging move-in fees? These things add up significantly. So when you go in and you secret shop those competitors, you can get a much more good understanding of that. And very many times they will be transparent, unbeknownst to them. They're trained not to, but many of them will disclose things like occupancy rates, et cetera. So you can get a relatively good understanding prior to the purchase, which is critical.
Right. What sorts of debt is available on this asset class?
So the lenders currently like this asset class. It's not as liquid as multifamily, for example. Right. Of course, obviously that's kind of the gold standard when it comes to liquidity. Right. But there are available financing options out there. However,
is it mostly regional banks or national banks, or is there agency debt, or just sorry?
I haven't seen any agency debt, but there is a lot of regional banks. There's also national lenders which specifically focus on the self-storage asset class, which is interesting because they might not be the least expensive way to go, but they understand the business so that if things go sideways, you have a friend that understands the business. And that can be really important in these tertiary asset classes. I mentioned earlier.
How could things go sideways? I can't let that go by without an explanation. Tell me how things go sideways.
Well, this is one of the areas that I think, multifamily presents itself quite strongly. When you're talking about investing in tertiary asset classes, I really like mobile home parks and self-storage. One of the challenges with them is that towards the end of the cycle, all of a sudden, all the lenders start to love the asset classes. They think they're geniuses. They want to invest in mobile home parks, et cetera. And then the second things turn around, wow, all those lending possibilities are gone. And it doesn't matter if you've been paying your debt service coverage ratio for the last 10 years and you've got a 50% loan to value. If there's no one that's going to lend you the money, it's a matter of, can you call your friends and give them $10 million loan in the heart of some kind of crisis? And like I said, multifamily people say, look, we're going to figure it out. There's so many available options out there. You don't really run into these liquidity crises. In the most recent correction, people struggled to get liquidity, even if they had a strong performing asset. So
what you're saying, I'm sorry. So you're saying if debt came due, it was a struggle to refinance and find that financing like it was in 08. Okay. Gotcha.
Yes. And in all fairness, obviously, I think you and I will both agree, 2008 was an aberration. It's relatively recent in our memories, but still, when it comes to downside protection, that's kind of I wouldn't say gold standard. That's like the opposite of the gold standard. It's horrifying, but we want to protect ourselves from that. And I think that the case that I'm, trying to make here with those two asset classes, demand is stable. I don't see a lot of data suggesting that's going anywhere. The challenge and what you want to be careful about is getting appropriate loans to value, appropriate debt service coverage ratio, a reasonably short interest only period.
Speak to what each one of those is.
Sure. This is something that I think doesn't get talked enough about. Investors, particularly passive investors, need to think really clearly about the lending portion of the capital stack. So I would say that 99% of all the challenges related to real estate, particularly related to loss of principal, have something to do with the loan. Mm-hmm. And so when you look at the loan, that's the majority of the purchase. And so you want to take a note of those details. So the first thing we want to look at is the loan to value, right? That's the loan to the value based on an appraisal or something like that.
Sure.
You also want to look at the loan to cost. Let's say, for example, you're buying a property for $15 million and you have a $10 million loan. Mm-hmm. Well, that's a relatively reasonable conservative loan. But if you're actually putting additional $2 million into capital expenditure, you're revamping the property, turning it from a B class to an A class, that is actually a significantly conservative loan. So it's important to take those into consideration.
Yeah.
Some of the other metrics that I think are important are the interest only period, which is the time at which the loan, the first 2 years, usually first year or so, they may not be paying itself down. Now, you will find that sometimes sponsors will have extended interest-only periods. And if you were not paying attention to the fact that this portion of the loan is not paying itself down, therefore the payment isn't as high, comparing apples to apples without counting for that, you may think that one deal is much better than the other without thinking about the financing side.
And let me put an exclamation mark on that, guys. I really want to hammer this piece home. Okay. In this hot market right now, and I've talked about this, I did a Facebook Live piece on this, even if you're just a passive investor, don't dabble. You've got to have enough of an understanding of whatever it is you're going to invest in. I don't care if it's the stock market. I don't care if it's the bond market. I don't care if it's multifamily, self-storage, mobile home parks, whatever it is. You need to understand that asset class. You need to understand that investment vehicle, because I'm telling you, there are a lot of sponsors out there that have not gone through a crash in 2008. They've never experienced a big pullback. There's a lot of irrational exuberance right now about deals. And I will tell you, I sometimes get floored when I see what some of these assets are trading for, selling for, that we turn down, and I see that they've sold with debt. And I'm thinking, good God, I wouldn't want to be a passive investor in that deal, because, if there's a hiccup, there's going to be it's going to be a train wreck. And so, guys, if you're interested in, mobile home parks, get an education. You're interested in self-storage, get an education. If you're interested in multifamily, come see me at one of my live events, or at the very least read my book, but get educated, because listen, it's very easy, like Hunter just said, to make the numbers look like they make sense. And if you don't know what you're reading, anybody can make a pro forma look great. It's very easy to minimize the expenses or play with the numbers. So you've got to understand what it is you're looking at. Would you agree?
Yeah, I actually really appreciate that, everything you said. I think that another side of that same coin is also that this has been one of the most remarkable and longest expansionary periods in the history of the United States, and also by far the most incredible commercial real estate comeback we've ever seen. Mm-hmm. And so there are companies out there and investors that are not only looking to place capital because other asset classes are extremely challenging, but also incredible returns have been produced that on a risk-adjusted basis are not repeatable. And so as an investor, it's an incredibly important time to do the one thing that almost no one is doing. Look in the mirror, analyze the deal, and say, is this repeatable without that cap rate compression? And that's the thing a lot of people aren't talking about. It's not great for marketing, but it's really, really critical to do, because everyone's going to be having that conversation in 5 years. All of a sudden, that's all they want to talk about.
Trust me, or it could be next year. I'm going to tell you that nobody knows, and everybody knows real estate goes in cycles. I've been through a couple of downturns, and one bloodier than the other, but I've been through a couple, and I will tell you, it's sobering, and it's going to happen again. And, if there's nothing worse than, like you described, having an asset that's cash flowing and you can't refinance, and your debt is due, and losing that asset because you can't place, you can't refinance the property. And so, that's a bad day when you've got an asset that's cash flow and you lose it because it's too tight. And so, and interest rates are going to go up. Anybody that thinks otherwise is kidding themselves, and maybe not as aggressively as they market. And that hasn't happened, but and when interest rates go up, cap rates go up. And so, it's the way it works, guys. So, get an education. Bottom line, get an education so that you're not, especially if you're passive, so that you're not. And so, those of you thinking about multifamily, for example, you don't have to just be an active investor to get educated. Okay, even if you're just going to invest your hard-earned money in somebody else's deal, come see me and get educated. And that goes for any asset class. You agree, Hunter?
Yeah, absolutely. I think that's the thing when people say, what's your suggestion for people that are just getting started? Look, it's a really exciting time to invest in real estate. There are opportunities. That's all I see is opportunity everywhere I look. But if you're just getting started, what you need to do all in, like the poker analogy, go all in on education, because that's something that's going to always work. And then once you do feel comfortable, start making moves and be focused and take action on a daily basis. And you're going to be in a really good position in a reasonable amount of time. Love it.
Okay. We got to wrap it up here, but let me ask you, what books do you gift the most to other people?
Man, there's 3 books that I think done concurrently are really powerful. Okay. Grant Cardone, 10X, which I'm sure a lot of people are familiar with. Yeah. So the first one is that one, then immediately followed by Miracle Mornings for Entrepreneurs, which is a great kind of anecdote to that. And then followed by Deep Work, which is about basically blocking out significant amounts of time to accomplish things that are actually going to grow your business. The reason in that order is because they're almost like antidotes to each other, in the sense that Grant Cardone, you guys know him. He's a maniac. Oh yeah,
he's been on the show twice. He's a hoot.
Yeah,
I love interviewing him. Yeah,
he is the king of go as fast as you can in as many directions as you can. Cameron Herold is really good at systematizing that approach. And Deep Work is like,
I thought it's Hal Elrod. Isn't the Miracle?
Correct.
Okay, Hal Elrod.
Correct, but the one Miracle Mornings for Entrepreneurs was co-authored by Cameron Herold.
Oh, okay.
So I think most people are interested in, the morning routines, et cetera, which is an important piece of the book. The second half of the book is written by the COO of Got Junk, and he took the business from very small to extremely large. He's a brilliant person when it comes to systems and putting the stuff in practice, like from an operational side of things, being the COO, obviously. And then Deep Work is actually written by someone who's in the world of academia, where they need to write, extensive, really cognitively demanding tasks. But it's important to do that in long, drawn out increments, sometimes weeks at a time. Certain people like to do different things. I like to do I work from 7:30 to 10 without answering emails every day. That's when the stuff that actually grow your business happens. So don't mean to go on a tangent.
Listen, buddy, that was great, because, I teach my coaching students to block time for what's most important. I block it. I cut out whole days for that creative time, that deep work time. I love it. I had not heard about that book. Absolutely.
You're gonna like that one.
And I didn't realize that Hal Elrod co-authored that book about entrepreneurs, and that the You Got Junk guy played a role in that. And of course, systemization is critical. Michael Gerber and E-Myth, is a great book for that. So I'm going to pick up both those second 2 books that I don't have. Well, listen, my friend, it's been a lot of fun. I appreciate you being on the show and adding value to my listeners, and let's stay in touch.
Yeah, I really appreciate it. And I will say, I really like the structure of the program. I love the educational content. You're really setting yourself out there. So I really appreciate you having me on today.
That's kind of you to say that. All right, brother, take care. Hey, thanks for watching. Please subscribe to my channel. And if you listen to podcasts, join me on iTunes, Stitcher, or wherever you listen to those podcasts. Just search for Lifetime Cash Flow through Real Estate Investing.